Hey there, and welcome to this explainer. If you just glance at the mainstream headlines right now, you'd probably think we're either in the middle of this perfect tech boom or, conversely, on the absolute verge of total political disaster. But if we actually look closely at the data, the real tectonic shifts happening right beneath our feet, well, they aren't those loud, flashy narratives you're seeing all over social media. Not at all. They're hidden fault lines. So today we're going to stick strictly to the data, break down the mechanics, and reveal the underreported financial anomalies that are literally reshaping the world's markets as we speak. So that begs the question, what actually is the biggest risk to the economy? I mean, ask the average person on the street, and they'll confidently tell you it's the artificial intelligence bubble popping. Or, maybe they'll blame politicians in Washington, or point to tensions overseas. But the thing is, they're looking in the completely wrong direction. The biggest risk to the global economy is actually something way more boring. It's something foundational that has literally been the duct tape holding the whole global financial system together for 30 years. Are you ready for it? It's Japanese government bonds. Okay, let's dive into this. Here's our roadmap for today. We're breaking this down into 5 distinct sections. First, the yen carry trade. Then, crypto's broken promises. Third, echoes of the Nifty 50. Fourth, the golden alarm. And finally, navigating the gray area. All right, kicking things off with Section 1, the yen carry trade and the foundation of global liquidity. So for decades now, following the burst of their own massive asset bubble, Japan's zero interest rate policy inadvertently turned the entire country into the world's ATM. Just imagine you're an investor, okay? You go over to Japan and you borrow money in yen at essentially a 0% interest rate. Free money. Then you take that free money, convert it over to US dollars, and you just buy US treasuries that yield around 4%. After a couple of minor hedging costs and fees, you just pocket the spread. And honestly, when borrowing costs are literally zero, investors don't just stop at safe treasuries. No way. They buy tech stocks, they buy real estate, emerging markets, you name it. We're talking trillions of dollars flowing out of Japan exactly like this, acting as the absolute duct tape of global finance. But here is the terrifying unwinding process that we're actually seeing play out right now. In 2024, the Bank of Japan finally raised interest rates. And by doing that, they broke the single foundational assumption keeping this entire massive system afloat. Look at the steps here. When Japan raises rates, suddenly borrowing yen becomes expensive. The math completely flips. That 4% treasury yield doesn't look quite so juicy anymore. So what happens? Investors aggressively sell off their U.S. assets just to pay back their loans. All that money comes rushing back home to Japan, and global liquidity immediately tightens up. Basically, the cheapest source of money in the world, it's no longer cheap. And this unwinding is incredibly dangerous, mostly because of what Ray Dalio points out right here. The bond market is the basis. It's the backbone of all markets. It essentially dictates what all other asset returns are going to be. See, for decades, Japan has been one of the largest, most consistent buyers of U.S. long-term debt. So if Japanese buyers suddenly step back, basic supply and demand dictates that U.S. Treasury yields simply must rise to attract new buyers. And when long-term yields go up, well, stock valuations get completely crushed, corporate borrowing gets super tight, and mortgage rates stubbornly refuse to fall. Seriously, everything is anchored to this seemingly boring, invisible bond market. Moving right along to Section 2, crypto's broken promises and the speculative mirage. Let's trace this timeline all the way back to 1983, when the idea of an anonymous e-cash was first proposed. Fast forward to 2009, the first Bitcoin was mined, and it came with this massive utopian promise of a totally decentralized currency entirely free from government control. Fast forward again to 2022, and, well, we see the absolute catastrophic collapse of Terra and FTX. That promised digital revolution, it basically devolved into one of the largest wealth destructions in modern history, wiping out billions and billions of dollars. What was supposed to be this groundbreaking new payment system just turned into a highly volatile trading vehicle. Just look at this number, 3.7 million. That is the actual number of crypto coins that have completely stopped trading and are considered dead just since 2021. I mean, over half of all the cryptocurrencies tracked recently have gone completely to zero. Think about it. When a normal traditional company fails, you might at least have a claim on some physical assets. Here, you get a JPEG and a deleted Discord server. It's wild. This entire industry operates far less like a revolutionary currency and much, much more like a rigged casino. And the case for this being a complete digital mirage only gets stronger when you actually look at its utility. For starters, Bitcoin has a 60% annual volatility. That's roughly 4 times more volatile than the U.S. stock market. And out of roughly 350 million businesses worldwide, only about 18,000 actually accept it. Plus, rampant fraud and rug pulls are literally everywhere. I mean, sure, you can technically use it as a currency, but as our source material perfectly puts it, using Bitcoin as a currency is a lot like trying to mow your lawn with nail clippers. It really has no intrinsic value. It's a purely speculative asset driven almost entirely by greed and hype. All right, that brings us to Section 3, Echoes of the Nifty 50 on the top-heavy illusion. You know, there is a fascinating historical rhyme playing out right now in the mainstream stock market. Let's rewind back to the early 1970s. There was this group of one-decision stocks known as the Nifty 50. Investors truly believed that companies like Xerox and Polaroid were just going to grow forever, so they started paying absolutely ridiculous price-to-earnings multiples. We're talking 90 times earnings for Polaroid. And guess what? When that bubble burst in 1973, the market crashed 50%. Now look at today's AI-fueled Magnificent Seven. We are seeing the exact same mental gymnastics. Investors are essentially pre-ordering hope, they're paying these massive premiums, and they're whispering the absolute most dangerous words in all of finance. This time, it's different. To put that top heaviness into perspective, the Magnificent Seven currently make up a staggering 35% of the entire S&P 500. And because of this massive shift toward passive index investing, every single dollar that flows in disproportionately buys more of these giant tech companies, which just drives their prices even higher. It's a beautiful feedback loop, right up until it isn't. The market has become incredibly, dangerously top-heavy. If a giant like NVIDIA stumbles, it doesn't just stay isolated. Oh no, it drags down the NASDAQ, the S&P 500, and your completely diversified retirement portfolio right along with it. And historically speaking, look at this. Since 1954, the S&P 500 has averaged a pullback of at least 10% about once every 3 years. Now, while the current bull case relies super heavily on massive government deficit spending and the promise of future interest rate cuts from the Fed just to keep the party going, the actual data tells us that corrections are entirely normal. They're healthy. Frankly, we are statistically way overdue for a reversion to the mean. Which segues nicely into Section 4. The golden alarm, and the ultimate fear asset. So while the stock market has been busy partying near all-time highs, gold, the ultimate fear asset, has quietly been putting up Wilt Chamberlain numbers. Think about this. For 80 years, the US dollar has been the undisputed global reserve currency. But over the last 2 decades, central banks have quietly dropped their dollar reserves from 70% down to 58%. Now, they aren't panic dumping the dollar, because honestly, that would trigger a complete global meltdown. Instead, they're just quietly diversifying. They are literally tiptoeing out of the room, shifting away from their blind faith in the US dollar to what we can really only call conditional trust. I mean, central banks are currently buying over 1,000 tons of gold annually. That is more than double their historical average, marking the highest level of gold buying in recorded history. And let's be clear, this isn't just a simple inflation hedge. Gold barely even moved during those massive inflation spikes we saw back in 2021. No, this buying is preemptive institutional anxiety. The biggest, most powerful players in the world are nervously hedging against rising U.S. debt and a future financial system that they quite simply no longer completely trust. And finally, Section 5, Navigating the Gray Area and the 2026 Dissonance. So when we synthesize all these fault lines we've talked about, Japan's yield impact, crypto's empty hype, wildly top-heavy stocks, and this historic gold hoarding, a really severe market dissonance emerges. Historically speaking, markets usually pick a lane, right? Either confidence is high and stocks soar, or fear is high and gold rallies. But right now, both are sitting at all-time highs simultaneously. Stocks are priced for this optimistic, infinite AI growth, while gold is priced for a highly troubling, uncertain future. The markets are sending us completely mixed signals. We aren't necessarily looking at an imminent melt-up or some apocalyptic crash. Instead, we're entering this really treacherous, choppy gray area where capital just sort of rotates, rallies stall out, and impatience ends up destroying portfolios. Which leaves us with this final and, I think, really provocative thought. In a market that is sending such mixed signals, how are you positioning yourself for the gray area? Because the reality is, the most dangerous threats to your portfolio aren't those loud clickbait headlines you see every day. They are the anomalies hiding right in plain sight. I strongly urge you to think critically, look way past the mainstream noise, and keep learning about these hidden mechanics. Thank you so much for joining me on this explainer, and hey, keep your eyes open out there.